Now in this input tax credit chapter, you take page page number 98. Page number 98, you see that the first thing that you need to know is about section 41 read with rule 36 sub rule 4. Section 41 says that only the matched ITC can be availed. What is matched ITC? That ITC which is reflected in GSTR 2B of the recipient. We have total GSTR 1, 2A, 2B and 3B, like this 4 returns. GSTR 1 contains the details of outward supplies, and every registered person has to report their details in their outward supplies in GSTR 1. So basically supplier will file GSTR 1. GSTR 2A is an auto-populated statement that is given by the portal that contains the details of inward supplies based on the GSTR 1 which is filed by the due date. So GSTR 2A and 2B both are inward supply documents only, but only difference is that 2A is dynamic, it will keep on updating, but 2B is static. Only those information which is filed by supplier in GSTR 1 by due date only will be reflected. 3B is a consolidated return that contains the details of outward supplies and inward supplies, and this 3B is the return where we need to pay the tax, but at the time of filing 1 the tax payment shall not arise. ITC details also will be reflected in 3B only. So difference between 2A and 2B is that 2A is dynamic whereas 2B is static. TDS TCS details, that is TDS deducted by our recipient and TCS deducted by our e-commerce operator, will not be reflected in 2B but it will be reflected in 2A. And details of invoices if GSTR 1 filed after due date. So if 1 is filed after due date also in 2A it will come, but 2B it will not be reflected, but it will be reflected in next month 2B. And the purpose of 2A is just for reference purpose, whereas 2B is for availment of ITC. And matched ITC should be availed, but we have a relaxation that self-assessed ITC can be availed. So supplier will report the details of outward supply in GSTR 1 or IFF from there, and it is filed by the due date. From there it will go to 2B of the recipient, and invoices or debit notes which are accepted in by the recipient will go to 2B, but it is optional. It is optional, not mandatory. If no action is taken in IMS, automatically everything will be reflected in 2B, that is matched ITC. To that we are making these 6 adjustments. 3 cases it is reflected in 2B but ineligible, blocked ITC, non-business purpose, exempted supplies. 3 cases reflected in not reflected in 2B but eligible, that not reflected in 2B but eligible. What is it not reflected in 2B but eligible? GST paid under RCM, reavailment of ITC reversed earlier, ITC not availed in earlier period but reflected in 2B of that period. Next, section 41 read with rule 37A. The previous page is section 41 read with rule 36 sub rule 4. This is section 41 read with rule 37A. Supplier will report the details in GSTR 1, it is filed by the due date. Based on that, to the recipient, ITC is reflected in 2B, and recipient can avail the ITC in 3B self-assessed, and of course this IMS one functionality is there. Now what happens? Step 4, supplier did not file 3B by September 30th of next financial year. So the recipient should reverse the ITC after September 30th of next financial year, but before November 30th of next financial year. If not reversed by November 30th of next financial year, they have to pay interest. What rate? At the rate of 18% from the date of utilization till the date of reversal. Date of utilization means the month in which the balance in ITC falls below the wrongly availed ITC. To that extent ITC has been utilized. And suppose if supplier files 3B after September 30th of the next financial year, what will happen? The recipient, whatever ITC that he has reversed, can re-avail, and in this case of re-availment there is no time limit. Usually there is a time limit for availment of ITC, that is 30th November of succeeding financial year, or date of filing annual return, whichever is earlier, but that time limit is not applicable in case of re-availment under this rule. Then next we saw section 49 subsection 5, manner of utilization of credit, and 4 principles. Principle number 1, there is no restriction with respect to IGST, means IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. But with respect to other 3, CGST, SGST, IGS, UTGST, cross utilization is not possible. And principle number 2, priority, IGST credit first for payment of IGST, thereafter CGST, SGST or UTGST, that can be in any manner, any proportion, and that is given in rule 88A, but we need to see the liability in that ratio, otherwise equal ratio we can divide the excess IGST credit. Then CGST credit, SGST credit, UTGST credit first for its liability and thereafter for payment of IGST. And principle 3, before utilizing CGST, SGST, UTGST credit, the credit of IGST should be exhausted first. So the first credit that should be exhausted is IGST credit. And last principle, for payment of IGST liability, credit should be utilized in the following order: first IGST credit, then CGST credit, then SGST or UTGST credit. Then IGST credit after utilizing for payment of IGST liability can be used for payment of both CGST and SGST in any proportion. So multiple answers are possible, but depending upon the liability, it should be apportioned. Compensations is now not there, but if compensations as credit is there, what should be done? Compensations as credit can be utilized only for payment of compensations as, but cannot be utilized for any liability. Then we saw section 16, conditions for availment of ITC. So total 8 conditions are there. Number 1, only a registered person can avail the ITC. Inward supplies should be used or intended to be used, either used or intended to be used in the course or furtherance of business, and the person availing ITC should be in possession of tax paid document. That tax paid document is tax invoice, debit note, ISD invoice and bill of entry. Then recipient should have actually received the goods or services, and even recipient should have filed the returns. These are the 3 additional conditions to be fulfilled by the recipient. Then supplier also should fulfill certain condition. Supplier should have filed GSTR1 and reported the invoices in GSTR1, and those invoices reported in GSTR1 should not be restricted in 2B, means it should not be in ITC not available column, and the supplier should have paid the tax subject to section 41, means he need to pay tax by September 30th of the next financial year. So that is this, supplier should have furnished the details, they should have paid the tax by September 30th of next financial year. GST paid on inward supply should be reflected in 2B under ITC available and should not be restricted. As per section 38, in few cases ITC will be restricted in 2B. 5 cases. Number 1, supplier is a newly registered business and up to the prescribed period ITC will not come under ITC available. Supplier defaulted in payment of tax and the default continues. Supplier liability in 1 is greater than 3B, and supplier ITC in 3B greater than 2B, and supplier has to pay 1% of liability through cash ledger, but he did not pay. In these 5 cases, against those suppliers when we are purchasing, it will be reflected in our 2B under ITC not available, so we cannot take ITC. As and when supplier fulfills those conditions or rectifies those mistakes, then it will move to ITC available and we can enjoy the ITC. Then what are the contents of invoice for availing ITC? Basic certain details should be there, that is GSTN of the supplier, GSTN of the recipient, then description, value, tax and place of supply in case of interstate supply. What is the meaning of inward supplies? Either inputs or input services or capital goods. Inputs means anything which is not capitalized. So any goods purchased and capitalized is capital goods, so charge it to P&L is inputs, and any service received will be input services. Then there is a concept of deemed delivery. When goods are handed over to a third person on behalf of the registered person, the day on which the third person has received the goods or services, it is deemed that the registered person has received the goods or services. But only condition is that the registered person should authorize the supplier to give the goods or services to the third person. Then the third person received date will be taken as the date of receipt by the registered person, and the registered person can avail the ITC. and this point is extended in a circular for the X works contracts. So in case of X works contract, the supplier has to deliver the product at his factory gate and the recipient will arrange the transporter. Now the supplier will hand over the goods to the recipient's transporter. The day on which goods are handed over to the recipient transporter, it is deemed that the recipient has received the goods and the recipient can avail the ITC. So in case of X works model, OEM factory, car loaded in the truck on 10/8 and the dealer received the car on 5/9, even though he received actually on 5/9, but the goods are handed over to the transporter on 10/8. So 10/8 itself will be taken as the deemed date of receipt by the dealer and they can take ITC in this case. And the above clarification is applicable for all types of goods, and in the transit, if the goods are lost, destroyed, written off or disposed of as gifts or free samples, then the dealer who already availed the ITC needs to reverse it because that is a blocked credit. Then when goods are received in lots or installments, they can avail ITC with respect to a single invoice. They can avail ITC only on receipt of last lot or installment. Then next one, reversal of ITC for non-payment of consideration within 180 days from the date of invoice, rule 37. As per rule 37, when supplier is raising invoice, the recipient should make payment to supplier within 180 days from the date of invoice. If the recipient is not making payment to supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient should be reversed along with interest at the rate of 18% per annum from the date of utilization till the date of reversal. However, interest is not payable if the availed ITC is not utilized, and this provision is not applicable in three cases. Number one, supply covered under RCM and supply without consideration or payment made to some other person on behalf of the supplier, 15(2)(b) cases. Then again, as and when the payment is made by the recipient to supplier after 180 days, proportionate to the payment made, they can re-avail the ITC. Again here, there is no time limit for re-availment. Only in two places re-availment is possible. One is rule 37, another is rule 37A, and in both the cases, there is no time limit for re-availment. Then section 16 subsection 3, ITC not available on the depreciation component. That is, if the depreciation is computed on the tax. For example, if they are buying capital goods for 10 lakhs and GST is 1,20,000, if the depreciation is computed on 11,20,000, then ITC of 1,20,000 is not available. And time limit for availment of ITC, 30th November of succeeding financial year or date of filing and return, whichever is earlier. And this time limit is not applicable in case of re-availment of ITC reversed earlier. In case of debit note, don't see the invoice date for fixing the time limit. See the debit note date. If debit note is given on 10th of October, you see 10th October 2026, and based on that you decide the time limit for debit note. So don't connect it to the invoice. So in case of debit note, availment of ITC depends on the debit note date, but not the date of invoice related to such debit note. In case of RCM, whenever the self invoice is issued by the recipient, only then they can avail the ITC. Where registered recipient issues invoice to the unregistered supplier, the date on which recipient issues invoice is relevant for determining the ITC. That is time limit for ITC. So the self invoice date is relevant for availing ITC in the month in which self invoice is given, and the maximum time limit depends upon the date of self invoice. Next, time limit for availment of ITC for certain financial years. This is not applicable now, 16 subsection 5 and 16 subsection 6. Time limit for availment of ITC in case of revocation of cancellation of registration. So whenever there is a revocation of cancellation of registration, we need to check the time limit as per 16.6, that is the regular time limit as per 16.4 or 30 days from revocation order, whichever is later. And you can see that registered person can claim ITC on such invoice or debit notes in any return file within the regular time limit or 30 days from revocation order, whichever is later. But there is one important condition. What is that? Provided that the time limit for ITC not expired as on the date of cancellation of registration. If the time limit is expired as on the date of cancellation of registration, then we cannot avail the ITC with respect to 16.6. So means here financial year 24-25, there are some inward supplies. For these inward supplies of financial year 24-25, they should have availed ITC by the regular time limit. The regular time limit is say 30/11/2025 or 31/12/2025, whichever is earlier, 30/11/2025. That is a regular time limit. But they have not availed. They have not availed. And later next year what happened? As on 1/9/2025, the registration is cancelled. Up to 1/9/2025, for this financial year, invert supplies ITZ is not availed, and the time limit is not expired because they have a regular time limit of 30/11/2025. So the regular time limit is not expired. Now, from the cancellation of registration till the revocation order, during this period, they cannot avail ITZ as the registration is not active. And at a later point of time, that is after revocation order, within 30 days, that is as on 2/3/2026, within 2/3/2026, they can avail the ITZ because the time limit is here revocation of cancellation, regular time limit 30/11 or 30 days from revocation order, whichever is later 2/3/2026, they can avail the ITZ, and the condition is also fulfilled. That is, as on the date of cancellation, the regular time limit for availment of ITZ is not expired. Then next, section 17, apportionment of credit. Apportionment of credit we have. So first, inward supplies used exclusively in taxable outward supplies or business purpose, we can avail the ITZ, no restriction. But if inward supplies are used exclusively in exempted or non-business purpose, ITZ is not available. If inward supplies are used for both taxable and exempted outward supplies, ITZ proportionately available. If inward supply used for both business and non-business also, proportionate ITZ available. And where we need to segregate, zero rated supplies. Zero rated supplies should be grouped under taxable supplies for the purpose of availment of ITZ. Next, we have meaning of exempted supplies in 17.3. So total, you need to remember 8 transactions as exempted supplies for ITZ purpose. Number 1, notified as exempted. Number 2, nil rated. Number 3, non-taxable. Number 4, supply covered under RCM. Number 5, sale of land. Then sale of building where entire consideration is received after obtaining completion certificate. Sale of securities and supply of goods by a duty-free shop to the incoming passengers. So, sale of goods by duty-free shop in international airport to which passengers? Only to the incoming passengers. To outgoing passengers, that is zero rated supply, that will be grouped under taxable. So, these are the 8 transactions which are treated as exempted supply. Here, in case of sale of land, we need to take stamp duty value. Sale of building also stamp duty value. In case of sale of securities, 1% of the sale value of such security should be taken. Then here there are 2 relaxations, that is interest on loans, advances, deposits, even though it is exempted. Sale of duty credit scrips, even though it is exempted, but we will not keep it under exempted, we will treat it as taxable. So services by way of accepting deposits, extend loans in so far as the consideration represented by way of interest or discount is treated as taxable. Okay, that is excluding these 2, and in that this, but this is except in case of banking company, financial institution, NBFC, which means for a bank, don't sleep here, for your sake only I am revising. Okay, don't sleep. So in case of bank, financial institution or NBFC, so what they will do is that they have to treat this interest on loans, advances, deposits as exempted both for payment of GST as well as for ITZ. But others, they will treat it as exempted for payment of GST, but while computing the turnover for ITZ purpose, they will group it under taxable. Then generally sale of duty credit scrips is exempted, but for availment of ITZ it should be treated as taxable. Then next we saw rule 42. 42, manner of availment of ITZ in case of inputs and input services. First we need to take T. T refers to total tax paid on inward supplies. From the total tax paid on inward supplies, 3 things we need to exclude. This is in line with self-assessed ITZ. That is T1, inward supply used for non-business purpose. T2, inward supply used for exempted outward supplies. T3 is blocked ITZ. these three things we need to remove. So once we remove these three things, then what we get is known as ITC availed in GSTR 3B. From that is C1. From that we need to separate T4, inward supply exclusively for taxable and business purpose. If you take out, the remaining is known as common credit. That common credit we need to see how much is used for exempted supplies, that is D1, common credit into E by F, and how much is used for non-business purpose, that is common credit into 5%. But remember, we will get common credit with respect to non-business purpose only if any single invoice is there in the common credit, which is partly for business, partly for non-business. If you know exactly, we can distinguish or segregate it in T1, T2, T3, T4 stage itself. Now, what is the net eligible ITC? First we need to take C1, ITC availed in GSTR 3B minus ITC reversed. What is ITC reversed? D1 and D2, that is known as net eligible ITC for set off. And we need to do this computation separately for CGST, SGST, UTGST or IGST. And this D1 and D2 again we need to recalculate at the end of the financial year. And suppose if we have to reverse excess amount, so that we need to reverse along with interest at the rate of 18% from 1st April of the next year till the date on which we are doing that reversal. 18% per annum from April of succeeding year till the date of payment. What if it is less? If it is less, we can re-avail the ITC. So in which return? In any return that is filed by September. So it should be understood like this. In any return you can do the reversal. April, May, June, July, August. Even availment of excess ITC also April, May, June, July, August. But that return is 3B return, and that 3B return should be filed by when? September. So reversal also by September, availment also by September. Then we have seen rule 43. Rule 43, manner of availment of ITC with respect to capital goods. I have capital goods 1, which is used exclusively for taxable and business purpose. Can I take ITC? Yes. I have capital goods which is used exclusively for exempt and non-business purpose. I cannot avail ITC. If I have capital goods which is partly used for taxable and business, partly used for exempted or non-business purpose, can we take ITC? Yes, but we need to reverse proportionately for the next 60 months. What is the treatment in case of capital goods 2? First we will avail the ITC 100% with respect to GST paid and transfer it to the electronic credit ledger. Thereafter we will see the monthly ITC. How much is the monthly ITC? Total ITC divided by 60 months. That is monthly ITC, and here assumption is life of capital goods as 5 years or 60 months. That's the usual assumption we need to take. Suppose in question some other period is given, you would go by that period. If nothing is given, you take 60 months. For the next 60 months, what we need to do? Monthly ITC into exempted turnover of that month divided by total turnover of that month we need to reverse. And we need to pay interest at 18% from the date of availment till the date of reversal. Here it is not date of utilization, date of availment only. And suppose in this 60 months, in any one month, we have sold the capital goods, this common capital goods. Should we do the reversal? No. When the capital goods are not with us, we don't have to do the reversal. For example, you used for 48 months and thereafter you disposed of the capital goods. You don't have to do the reversal. Anyhow, on disposal of capital goods on which ITC availed, 18(6) will come into the picture. The above procedure is not required from the month in which the capital goods are sold, as GST is payable in such case under 18(6). Then initial purchase is capital goods 1, means you are using it fully for taxable and you availed the ITC. At a later point of time, we are using it for CG2, that is common. What is the treatment? As ITC already availed, no need to avail ITC, just consider it as common ITC and you need to do reversal for the balance life. So monthly, first ITC already availed at the time of purchase, so no need to avail common credit. Monthly ITC equals to original ITC by 60 months, and proportionate reversal we need to do from the date of conversion for the balance useful life. And for computation of interest, we need to consider ITC availment as the date of conversion. Then next, suppose initially you purchased and used for CG3 and at a later point of time it is used for CG2. Can we avail the ITC? No, CG3. CG3 means at that time we have not availed ITC. So now only we are availing the ITC and we consider it as common ITC. ITC not availed at the time of purchase, but it should be availed now, nothing but GST paid. But for the past period, there are two reversal, past reversal and future reversal. For the past period, we need to reverse by taking ITC into GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And what is the monthly ITC? Monthly ITC will be original ITC divided by 60 months. What is this month-wise quarter here refers to? That is quarter or part thereof means you need to take like January to March as one quarter, and then we need to take June to, that is July to September as one quarter, like that. Okay. Then next, proportionate reversal from the date of conversion for balance useful life, interest computed from the date of conversion. Then we have one clarification in this regard. Insurance companies which will go for, life insurance companies which will go for valuation under rule 32 sub rule 4, that is they will not pay GST on the total premium received. That premium on which they are not paying GST, not considering to the value, should not be treated as exempted supplies. Therefore this rule reversal under rule 42-43 shall not arise. Then special provision for banking company, financial institution and NBFC, section 17 subsection 4. They have two options. Option 1, they will avail the proportionate ITC. Option 2, they will avail 50% of the eligible ITC. And they have to decide this option in the beginning of the financial year, and that will be applicable throughout the financial year. In case of option 2, only ineligible ITC and blocked credit, that is used for non-business and blocked credit alone we will not take. Rest of the credits and all exclusively used for taxable, exclusively used for exempted and common, everything will be taken into 50%. In case of option 2, inward supply exclusively used for non-business and blocked ITC, ITC should not be availed. But 50% compute on remaining ITC, including used exclusively for exempted or taxable. And in case of option 2, so 50% point is not applicable in case of inward supply from a distinct person. Full 100% they can take, but proportionate ITC they need to reverse. And option 1's excess cannot be withdrawn during remaining part of the year. And this is about blocked ITC. So blocked ITC, the first one is motor vehicle related blocked ITC. Motor vehicles divided into 3. Motor vehicles for transportation of persons, vessels and aircrafts, and others. Others like trucks, lorries, etc. ITC is already available because it is not a blocked credit, always available. Whereas for transportation of persons, capacity less than or equals to 13, capacity exceed 13. Capacity exceed 13 is not blocked ITC, we can enjoy the ITC, example buses or maxi cab, tempo traveler. Whereas capacity does not exceed 13 is blocked credit. However, 3 exceptions: further supply, used in the business of transportation of passengers, driving schools, then ITC available, other case ITC not available. Whereas for vessels including yachts, so yacht should also be considered as vessel only here, vessel including yachts and aircraft. So here we have 4 exceptions, other cases ITC not available. What are the 4 exceptions? Further supply, used in the business of transportation of passenger, driving schools, and used for transportation of goods, ITC is available. Then next, repairs for services in relation to motor vehicles. If the motor vehicle purchased is eligible for ITC, these 4 services also eligible for ITC. If the motor vehicle purchased is not eligible for ITC, on these 4 services also they cannot take ITC. What are those 4 services? Repairs and maintenance, insurance, servicing, hiring, renting and leasing of motor vehicles. While determining the capacity, we need to include the driver seat. And here further supply, I am buying a motor vehicle and used it for further supply, so I can take ITC. That further supply can be either sale of the motor vehicle or renting of motor vehicle. That is this second point. Then Repairs, insurance and servicing of motor vehicles received by an insurance company is always eligible for ITC. Then hiring, renting and leasing of motor vehicle is a blocked credit, but we have one exception, that if it is under a statutory obligation by employer to employee, then they can take ITC, and statutory obligation can be under any law. Then ambulance and caravan are not motor vehicles for transportation of persons, it will come under other motor vehicles and we can avail ITC. Now there is one circular whether ITC is available on demo vehicles used by dealers for showcasing and test driving to potential customers. Yes, ITC is available because it will facilitate the further supply of goods, but here we need to remember that the depreciation, because this is an asset, not inventory, because this is a demo vehicle and we need to capitalize it at value excluding the GST for depreciation purpose. And suppose if this demo car is sold in future, as and when it is sold, we need to pay GST in terms of 18(6). And if this demo car is not used for business purpose or used in marketing activities, etc., then ITC is blocked, ITC not available. Then what is the treatment of ITC on repair expenditure to the insurance company? If the bill is in the name of the insurance company can take ITC, whether the insurance company is making payment to the service center or the insured is paying and the insurance company is reimbursing. So whether it is reimbursed or cashless, whatever it may be, insurance company can take ITC, but the invoice should be in the name of the insurance company. Suppose if they reimburse less than the claim amount, for example, if the repair cost is 1 lakh and if they reimburse only 70,000, proportionate to 70,000 only they will be able to take ITC. If invoice is in the name of the insured, insurance company cannot take ITC, but availment of ITC to the insured depends upon whether the motor vehicle purchase, because it is a repair expenditure. So if the motor vehicle purchased is eligible for ITC, on the repair expenditure insured can take ITC, otherwise no. Then construction related blocked credit, we have 3 inward supplies which are blocked ITC. Any services that is related to the construction, then works contract service or goods. These 3 are purchased or received in relation to construction of an immobile property. ITC available or not available? ITC not available. However, we have 3 exceptions. Exception number 1, the restriction is only to the owner of the good, owner of the property, but not to the supplier who is providing the construction service or works contract service. They can take the ITC. Second exception, if this expenditure is charged to P&L, then also they can take ITC. Another exception is that if this is for construction of plant and machinery, excluding telecommunication towers or pipelines laid outside factory gate. So these are the 3 exceptions. So now plant or machinery is replaced with plant and machinery. And works contract involves what? What is the difference between any service and works contract service? In works contract there will be both goods element as well as construction element for a lump sum consideration. Then, so suppose if builder can take ITC, again we need to check whether the builder's outward supply is taxable at 1.5% or 7.5% without ITC. If that be the case, builder cannot take ITC. But if the builder is paying GST at 18% or any other rate that is with ITC, they can take ITC on their inward supplies. Then whether ITC is available on ducts and manholes used in optical fiber cable network? Yes, because that is not telecom towers or it is not pipeline laid outside the factory gate, so they can take ITC, but even though this expenditure is incurred by the telecom companies. Then only hiring, renting and leasing of motor vehicle is blocked ITC. However, leasing of any other item is not blocked ITC. And works contract, that is leasing of furniture, leasing of or renting of cameras, equipments, etc., we can take. Then works contract service is confined only to immobile property. For movable property we will never call it as works contract service. ITC available on construction of pipelines inside the factory. The restriction is only pipelines outside the factory. And IT is available on train, 2-wheelers, 3-wheelers with a capacity up to 25 cc. Then vehicles used in enclosed premises, that is like forklift truck or battery operated cars, etc., they can definitely take ITC because again that is not motor vehicle. And next we have other blocked credits. In this other blocked credits, the first one is membership of a club, health and fitness center, that is a blocked ITC. Only one exception we have, if that is received by an employer for their employee under a statutory obligation. Then second, travel benefits extended to employees on vacation is blocked ITC. Again, there also we have the same exception, that provided by employer to employee under a statutory obligation. Then inward supplies of NRTP is blocked ITC, but one exception, import of goods by NRTP. Then inward supplies of food and beverages, that is related to food and beverages, outdoor catering, related to beauty, that is cosmetic surgery, plastic surgery, beauty treatment expenditure. Number 3, insurance, that is life insurance and health insurance. And exception, if inward supply outward supply is same category, or inward supply part of composite or mixed outward supply provided by employer to employee under a statutory obligation. Then apart from this, others, that is from a person opting for composition scheme for personal consumption or CSR obligation, or goods which are lost, stolen, destroyed, written off or disposed of as gifts or free samples. In this case also it's blocked ITC. But for these gifts or free samples we have one exception through circular. If that gifts or free samples constitute supply, then they can take ITC. ITC is not required to be reversed because that will become supply under 71C. And suppose if the supplier has not paid the tax voluntarily, but it has been recovered from the supplier, then can recipient take ITC? No. Non-availability of ITC with respect to GST paid under 74, that is under demand and recovery. Next, whether ITC available on goods purchased for free replacement during warranty period. First, if any goods are purchased and it is replaced during warranty period, either a part or entire goods, ITC is available because it is used in the course or furtherance of business, and it will not become supply under 71C, disposal of business asset on which ITC is availed, that is this too. Where a part or entire product is replaced during warranty, ITC can be availed on goods purchased for warranty irrespective of whether any consideration is charged or not with respect to such warranty. And again, when distributor is replacing, that when the manufacturer is replacing the stock of the distributor, whether it will become supply or not, no. So that replenishment, where distributor uses his stock for replacement and manufacturer replenishes the stock, on which manufacturer can avail ITC, but section 71C is not invoked in this case. Then what is the treatment of extended warranty? If it is at the same time from the same dealer, then it will be treated as composite supply and the rate of the product is applicable for additional warranty. In all other cases it will be treated as independent supply and taxable at the rate of 18%. Then section 18, input tax credit in special cases. 18.1 talks about availment of ITC on closing stock. Total 4 cases we can avail ITC on closing stock. 18.1a, a person is liable to get registered and he made application for registration within 30 days. Next, a person is voluntarily getting registered. 18.1b. 18.1c, a registered person who is under composition scheme is migrating to normal scheme. 18.1d, a registered person who was making exempted supply, now it became taxable. Now, in case of 18.1a, 1b, closing stock, input as such held in stock, input in WIP held in stock, input in FG held in stock, and here matching is not required. Which date closing stock should be taken? Immediately before the date they are liable to get registered, and here immediately before the date they got registration certificate. Then 18.1c, 1d, they can take ITC on extra capital goods and matching is required. Which date closing stock should be taken? Immediately before the date of migration or conversion. And the time limit for availment, that is this closing stock, should have been purchased within 1 year prior to the closing stock, means from the invoice date for the inputs and capital goods till the date of closing stock, it should be less than or equals to 1 year. And ITC with respect to GST paid on inputs can be availed as ITC. For inputs we don't have to reduce anything, full GST paid we can take, but for capital goods, so GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion. So we need to reduce, and this ITC will be availed in ITC 1 and the form will be filed within 30 days from the date they are eligible, and it can be extended by the commissioner, and this declaration shall be certified by practicing CACMA if the claim of ITC exceed 2 lakhs. And then section 18.3 talks about transfer of ITC. whenever there is transfer of business, that transfer of business may be on account of sale, amalgamation, merger or any reason, including change in constitution of business or death of sole proprietor, from the transferor electronic credit ledger, the ITC can be transferred to transferee's electronic credit ledger. For the transferor should file one form ITC2 and it should be certified by CA or CMA that this particular transfer of business is with specific provision for transfer of liabilities, and the transferee should accept it. Then the ITC will move from transferor credit ledger to transferee's credit ledger. And in case of demerger, we need to see the assets ratio for the purpose of distribution, and while taking the assets we need to take all assets whether ITC is availed or not, and transferor and transferee should be in the same state. When a single registration is converted into multiple registrations, also this transfer of ITC is applicable. From the single registration to multiple registration, again in what ratio? Assets ratio. Assets ratio as on the date of new registration should be taken, but here the form will be ITC 2A and there is a time limit of 30 days from new registration, and ITC to be certified by CACMA irrespective of the amount of ITC, but 2A we don't have any certification. And in case of demerger, which date ITC balance should be taken? Whichever date you are transferring, that date, but see the assets ratio as on the date of demerger. Then section 18.4 and 29.5 deals with reversal of ITC on closing stock. 18.4 is opposite of 18.1C 1D, that is normal scheme to composition scheme, and exempted taxable supplies to exempted supplies, and 29.5 is cancellation of registration. In these cases we need to reverse the ITC on inputs as such, inputs in WIP, inputs in FG. On capital goods also we need to reverse, that is ITC availed divided by 60 into balance life. And if the capital goods are purchased beyond 5 years, we don't have to reverse anything here because 5 years is over. Inputs and capital goods can be purchased anytime on which ITC availed. If ITC not availed, say for example some inputs we have not availed ITC but it is there in closing stock, should we reverse? No need to reverse. If ITC not availed on such inputs and capital goods, then reversal shall not arise. If capital goods are purchased before 5 years and on which ITC is availed, then also reversal shall not arise. Suppose if invoice pertaining to that capital goods is not available, then we need to see what is the closing stock date, and on that date what is the market value of those inputs, and accordingly we need to reverse, and as we go by market value we need to get a certificate from CACMA, and all these ITC reversal will be specified in ITC 3, and if there is any balance in ITC after reversal, that shall be lapsed. If there is any shortfall, then we need to pay using the cash ledger, and we have to do separate computation for CGST, SGST, IGST. Then we have section 18.6. 18.6 is applicable in case of capital goods. Two conditions should be satisfied. First, there should be supply of capital goods. Second condition, on that capital goods ITC should be availed. Then the GST payable will be A or B, whichever is higher. A is ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST on sale value. That value either you can determine under section 15 or you can determine under rule 30 or rule 31. So that should be taken whichever is higher. But this section is not applicable in case of three goods sold as scrap. Number one, refractory bricks, molds and dies, jigs and fixtures sold as scrap. We will just pay GST on sale value even though these are capital goods. Then section 19 deals with job work provisions. Section 19 read with section 143 of CGST Act. The same chart we saw. First, the principal will buy the inputs and capital goods. Second, they will avail ITC on the inputs and capital goods. And these inputs and capital goods is sent for job work. They don't have to reverse any ITC. And the job worker should return these processed goods out of that inputs and capital goods within the prescribed time limit. That prescribed time limit is 1 year, plus it can be extended for a further period not exceeding 1 year. And in case of capital goods, 3 years, and it can be extended for a further period not exceeding 2 years. And in case of 3 goods, molds and dies, jigs and fixtures and tools, this time limit is not applicable. And suppose if the inputs and capital goods are not received within the time limit, then the principal will treat it as supply on the day it is dispatched to the job worker, or on the day when job worker has directly received from the supplier of the principal, and that is the time of supply, and accordingly GST will be payable by the principal, and principal has to report all these details in ITZ 4, and the ITZ 4 frequency, if my aggregate turnover during previous year does not exceed 5 crores yearly once by 25th April, whereas in case my aggregate turnover exceed 5 crores yearly twice, half year, first half year by 25th October, next half year by 25th April, and such goods shall be sent to job worker under the cover of a delivery challan and e-way bill. Even if the goods are directly received by the job worker, ITC can be availed by the principal, and job worker he can take ITC or not, yes, provided he is registered on those goods which are purchased by the job worker for using the job work, they can take ITC. If processed goods or capital goods are returned by the job worker after 1 year or 3 years, it is treated as new supply by the job worker and chargeable to GST, which can be availed as ITC by principal. If job worker is not registered, the principal should declare the job worker's place as additional place of business of the principal, and even jurisdictional officer must be intimated about job work contract. Processed goods may be either brought back to principal's place or it can be sold directly from the job worker's place. Then we saw section 20 and 21, input service distributor, that is there is a office, any registered office which will take the ITC on input service and distribute it to the divisions or branches under the same permanent account number. That office which distributes the credit should get a recognition as a ISD and should get a separate registration even though they have a normal registration, and they will distribute CGST, SGST as CGST, SGST for the unit in the same state, whereas they will distribute it as IGST to the unit in the different state. Suppose if the service is attributable only to one unit, entire ITC will be distributed to that unit. Suppose if it is attributable to more than one unit, then you need to see the turnover of such units. Suppose if it is common, attributable to all, then it will be based on turnover of all operational units. And which turnover should be taken? Either previous year or last quarter based on the availability. And how this ITC to be distributed? It should be distributed on a monthly basis, and they have to file one return, that is GSTR 6 by 13th of the month following every month. Suppose if they have excess ITC availed, can that is excess ITC be distributed than availed? No. Excess distributed ITC, suppose if they distribute anything in excess to any division, it will be recovered by them itself by issuing a ISD credit note. Suppose if there is any shortfall, then that can be distributed using ISD invoice. Distributed credit should not exceed the credit available. If credit ISD has distributed in excess, the excess can be recovered from the recipient. If they are not adjusting through ISD credit note, it will be recovered from the division or recipient, so with interest, that is section 21. And ISD should get a compulsory registration, even though they already have a separate registration, but they need to get a compulsory registration as ISD irrespective of their turnover. And now even GST paid under RCM can be availed as ITC by the ISD, and they can distribute it to the divisions. And while computing the turnover for rule 42, rule 43 or section 20, the old indirect taxes, that is central excise duty, state excise duty, CST and VAT should not be considered. But this is actually an exception to the regular section 15, okay. And this point also we saw that duty credit scrip should be considered as taxable turnover. And with effect from 1/4/2025, ISD is mandatory and any other method like cross charge etc. cannot be followed. We completed, okay. So it took literally less than an hour, 1 hour, maximum 1 hour, okay. So that's what I said. If you need to cover the chapter which is discussed for 6 days. Actually, input tax credit total 6 lectures. 6 lectures means on an average you take 2 hours 15 minutes. Even Sunday also, one Sunday we covered na. So 6 2s are 12, somewhere like extra 3 hours if you put also 15 hours effectively. 15 hours to 16 hours we can revise in 1 hour, but you are not sitting on it. If you sit on it you can do, because while reading first time it will be difficult, second time it will not be. At least honestly tell me, while repeating these points, are you able to recollect that yes, we covered this somewhere like that? That is the power of learning. It's not because of me. Even if some donkey stands here and take classes also, it is the same. It's not because of me. It's because of you. If you have properly listened to the lecture once, okay. But while doing this revision, online students and all, some of the online students will find it difficult because they did not watch the lecture itself properly, or they would have watched it in 1.5 or 2x speed. I myself will speak in 1.5x speed. On the top of that, if you watch in 1.5x speed, I don't know how it will be, you will understand. So therefore, this particular lectures you have to listen, and then only revision will become easy. Now next time na, when you turn the pages, in half an hour you will complete. In half an hour you will complete. Trust me, that's how the process is. Okay, fine. Thank you. We'll meet tomorrow. And with this flow, try to solve some questions in input tax credit today in solve workbook, because already revision is done. I did it. You try solving so that this week exam you will be able to write properly.